Call is presented by FactSet, financial data and analytics powered by tomorrow. June 6th, 1 o'clock on the East Coast. Carter Braxton Worth, G Swizz here. Before we get started, I put this out on Twitter earlier. I want to read it because I think, we talk about heroes all the time in sports and in theater and in movies, but the reality is, there are very few heroes out there. But 80 years ago, a lot of people were. And I was watching CNN earlier this morning, and I said, watching these brave soldiers stand to receive their medals from Emmanuel Macron, and I'm in tears, which is true. Many have tried, but there are truly no words poignant enough to properly honor the importance of their acts of heroism 80 years ago today. And when you see now these 100-year-old men, mostly men, in their wheelchairs, but standing up to receive their medals, I mean, if that doesn't make you emotional, I don't know what does, because that's when good conquered evil, folks. Anyway, I'm getting a little wonky here, I know, but I just wanted to bring that up, Carter.
Awesome responsibility, obviously, giving one's life, but also think how Eisenhower, right, Allied Supreme Commander, having to make the decision to go, kept getting bad weather, and then he said, we got to do it, and they told him the casualties are going to be massive, but on they went.
And Eisenhower actually penned a letter that if it failed, which obviously it didn't, but, he was going to take full responsibility. He understood the magnitude of that decision. Anyway, I just wanted to bring that up because I do think it's important. But let's go right to it because it is Thursday. It is a pretty interesting day, I think, in the markets. And let's put the rundown up. Stocks are rallying to records. The S&P 500 made a new all-time high today. Many individual stocks did as well. We're going to do a chart check on the aforementioned market. And we're going to do a little catch-up trade ideas, which both Carter and I have. So stay tuned for that. But let's get right into it, Carter, because the first thing you want to look at in your charts, the S&P 500, getting through that prior all-time high, a check back down to it. But here we are seemingly breaking, at least seemingly today, breaking out.
Yeah, I mean, so this is the one aggregate that's doing it, and that is the interesting and ongoing curious nature of aggregate analysis, meaning, right, when we study the parts, we study the whole, we study the whole, we study the parts. And yet, again, S&P 500, what I thought we would do is something that's been done many times before, but just do it with fresh eyes. Look at this index versus so many others. So if we were to look at the next chart, you'll see here, that's the equal weight. Let's go back and forth. Actual, equal, actual, equal. And so there's a different story there, minor as it might be. But it's not just the equal weight. If you go to the S&P 400 mid cap, you go to the S&P 600 small cap. You can keep this going. You go to the or the Russell 2000 in this case. You can do any number, New York Stock Exchange Composite. What else do we have on here? The Dow Jones Industrials. We have the Value Line Arithmetic, one of the best performing indices of all time, so forth and so on. We might have others here, I'm not sure. But the one that has made a new high, besides the S&P, of course, is the SOX index, and you see it there. And yet, look at the equal weight SOX. It has not. And so it is just another way of telling the story or observing what we all know, is that so much is dependent on so few, not to, that's an expression that people use about D-Day, right? So never was so much owed to so few. But we have this circumstance in the market where just a handful of stocks continue to determine at least the course of the S&P, whereas so many other aggregates are not. Another way to do it, Guy, of course, is to look at this next series of comparative charts. Here, NASDAQ 100. Yeah, I forgot about this one. Look at the NASDAQ 100 equal weight. So it's, big story, big difference. And it would be a curious thing and a telling thing if we never were to get above those March highs. First week in March, here we are, first week in June. And it's only the S&P, because of its market cap nature, waiting in the NASDAQ 100. It's waiting in those top names that has done this. But another way to do it, we have some comparative charts. Now, this is, look at the perfect order in which this persists. So you have a blue line, and that's the Magnificent Seven. And this is year to date up, 30%. And then you drop down and you've got the S&P top 50 in green. And then the S&P 100 in brown, then the S&P 500 in black, then the mid cap, and then this small cap 600 in perfect descending order. The bigger you are, the more you've done. And we can take this exercise and go, let's go 1 year, let's go 2 years, let's go 3 years. And it's just the same story. Now it gets absurd. Look at 5 years and 10, right? And this is the thing. And one could say, well, there's nothing to say or learn or see here other than stick with winners. Very good point. And you try to find operating businesses that are better than other operating businesses. Walgreens Boots is a bad business, right? Or CVS, whereas obviously, selling things online like Amazon's better than a business than Walmart. But the question is, and this is where does the rubber hit the road? At what point is the market at risk because so few stocks are doing all the work? Or said in a different way, if there ever will be an exit or exits from those stocks, what would that do to the market?
So the 10-year is stark, but if you go even to the 5-year, which I think illustrates this a little bit, I want to say a little bit better, a little bit differently. So the 5-year comparative chart, and even the 3-year comparative. Let's go to the 3-year, because if you look at this, you'll see that effectively for a period of time, and again, it's all depending on where you look at a point in time, but these things trade almost in lockstep. And then obviously you had a huge divergence a while back. So the question, and again, this speaks to, and we talk about it, but when you see it this way, I mean, people want to say the market, the rally is broadening out, but effectively when you see this, it tells an entirely different story. So the question that I'll continue to ask you, that there's probably unanswerable, but you have an opinion, how do things reconcile themselves? And does it reconcile, obviously, in these basically 8 to 10 names sort of coming back down to earth? And then what does that mean for the broader market if in fact that were to happen?
Right. So many obviously subjects to cover in a chart like this. But the first thing, of course, is the worst one, the small cap, is negative, right? So the S&P 600 small cap, which is effectively the Russell 2000, is negative for 3 years. So as an investment prospect, and not to mention adjusted for inflation, it's a disaster. You've lost about 15%. The mid cap is up 8, the red line, but that means it's negative adjusted in real terms, and so forth and so on. And so then the question is, right, about this, is the blue line, is the concentration of capital in the blue line an offensive or defensive thing? What is generally known is that cyclical stocks are basically risk on, right? When things are booming, you go after a Ford Motor or a U.S. Steel. You go after a cyclical, economically sensitive, because you get the beta associated with a real turn or two on the income statement and the leverage implied. A lot of them are heavy in debt, because leverage, when it works for you, is great. When you're defensive, in general, managers go to growth, because growth, right, is sort of idiosyncratic. The thought is that a growth company can grow even if the economic environment is faltering. So the question is the money that's concentrating in the blue line people being aggressive and assertive, or in many ways, is it being defensive? It's both, because it's investing specifically in these very stable, prominent, successful moat-like businesses with a lot of cash on their balance sheet. But it's saying, I'm worried about maybe my shots on international paper, U.S. Steel. I'm thinking maybe, these mining stocks, Rio Tinto, and this is dangerous stuff. So it's both offensive and defensive. But at the end of the day, it's still about positioning and about money flow, and about, can something be so crowded that if it can go up this much and be embraced this much, what happens if it is abandoned?
I'm going to go off script a little bit here, because, we actually talked about this earlier in the week, and, and I don't want to say your work is simple. It's not my point, but you make it accessible. And, you've pointed out a number of times that when everybody was on one side of that crude oil boat in terms of being bullish, that was the time to sort of pull the ripcord. And recently, that's the pendulum has swung completely the other way. Crude's going back to $55 type of thing. And, you pointed out, I want to say this week, if I'm not mistaken, that now's the time to probably re-enter some of these energy trades. As I'm sitting here today, you have crude up significantly, $1.50 or so today. Now, granted, it's off probably what was an oversold condition, and I do think we sort of levitate back towards the flattening out, or even slightly moving lower, moving average. But, what are your thoughts on that? I mean, am I reading this the right way?
Yeah, I mean, obviously, in and of itself, that chart is a pair of twos. It's all over the up, down with no real character. But I think, it's a meaningful sell-off, obviously 87 to 74 or 73, and a bounce is here now at hand. But energy shares, right, and as measured by whether the XLE, the Spider, or individual, traditionally have a defensive characteristic. So that if you were to look at the energy sector's relative performance in 08 and 09, it was making all-time highs. I mean, energy is selling off aggressively with all publicly traded equities in the financial crisis, but making all-time relative highs because at the end of the day, they have that thing called proven and probable reserves, Exxon and Chevron, and that is an asset that is incontestable and is desirable. And energy shares in most market routes, most notably Exxon and some of the other big heavy units, are defensive by definition because of their yield and because of their basic, if you will, intrinsic value in terms of what they actually have in the ground.
So I look at Exxon here, and it's going to look extraordinarily similar to the XLE, which makes sense given its weighting. But, if you can put the XLE up real quick, you'll see that, again, we traded down to the moving average and seemingly have found a home there. If you broaden this out, and this is something that I pointed out for a while now, what I'll tell you is I was very bullish of the XLE for the majority. I still am. I want to be crystal clear. But I thought, and even longer term than that, I thought we were going to take out the prior highs that we made many years or so ago in terms of the XLE. I think it was sometime in 2014. So we traded up to these prior highs. I thought we were going to blow through. We stopped dead on that. Should that concern me? Again, duration in terms of double bottoms or double tops is meaningful. The longer the duration, theoretically, the more important of a top that is. Am I reading that correctly?
Yeah, ultimately, those highs will be exceeded. I mean, I think this is, and again, just to remind everyone, it's only 3.6% of the S&P. This sector. There are other small ones, of course, materials about 3, and utilities about 3, and real estate about 3. But for those who are interested in fundamentals, if you look at the net profits, just sheer billions of dollars generated by this sector, energy versus the other 3 that are at the 2 and 3 and 4% weight, this is double, right? So if you're a value player, this is your go-to spot, especially on this nice correction, this check back to a level of support.
The other thing that I'm going off script again, but I know you're capable of doing this. And my sense is there's nothing to see here, but I want to do it in the context of the importance. So throw up a KRE chart, same duration, maybe a 5-year or so KRE chart, which is an equally weighted. I think all the stocks in this index or ETF are about 2.5% or thereabouts. So you're basically looking at a swath of different companies, very similar in nature. Now, you saw that huge downdraft. That downdraft made sense as we traded down to the Silicon Valley Bank crisis, and we get it. In the absence of bad news, over the course of the next few months, it sort of levitated. But you look at that prior high, and you look at where we are now. I mean, we're nowhere near to taking out those prior highs. And again, this is in the context of some of the charts that you brought earlier in terms of performance in the face of different things. Now, here we are right again at a moving average. But I will tell you, Carter, that if in fact, and goes to little fundamentals, if you think about the lifeblood of our economy, a small and medium-sized business, their lifeblood are small and regional banks. If these banks are compromised, you start doing the calculus and you say, that can't be particularly good. And when I say compromised, I'm just looking at through the lens of an underperforming index. Thoughts on that?
I mean, look, this is a dangerous business, right? I mean, in the sense that lending done properly is a very good business. I mean, at the highest levels, not to bring up something, but at one point there was a magazine article, this is 15, 20 years ago, the 100 most powerful men or people in business. John Gotti was on there. It just said, bankers admire his ability to charge triple finger interest rates. The point is, lending is a good business, even if you're doing it in an unsavory way such as that. But the point is, it's also a very dangerous business because everybody knows that great expression. When you owe your banker $50 million, he's got a big problem. When you owe him $500 million, he's got a big problem.
That's right.
And so you're left on the hook and so forth. These are a lot of these regional banks don't make any money. A lot of them are very exposed. And obviously that Silicon Valley Bank thing, what really got exposed there is that in the modern era, you can, with your telephone, withdraw all your deposits.
In the blink of an eye.
And
You
then
don't have
blink
to
of
wait
an eye.
online with
And
Jimmy
so,
Stewart, and
and
you can
that's
do it.
scary stuff. All right.
Right.
You cannot blink away the proven and probable reserves at Exxon. So that is what this is. Not for me. I would say no trade here. If anything, I'd rather be short, especially if and as there is some slowness coming in the economy. This is not where you want to be.
Yeah, I agree with that, and I just wanted to bring it up again in the context of things that have not, you think of the S&P 500 in and of itself, it's done well, and you look at this, you're like, wait a second, this is telling an entirely different story. One of the things that we teased is the catch-up trade, and I'm going to throw two of mine out there, and these are, by the way, have been two names that I haven't particularly loved recently, but I think maybe both of them are finding a home. So let's throw Target up first, because the woes of Target are well known and self-inflicted wounds without question. But I look at this and say, okay, we traded down to the moving average, seemingly held. We bounced. We're looking like we're going to test it again. Longer term chart, if you can, you'll see, that maybe we found a level that sort of makes sense for the context of a trade. I look at Target and I go back sort of 5 years, and this level we're sort of, I don't know, hanging out at. These were sort of the lows if you go back all the way to the summer of 2022 or so, sort of this 142, 143 level. So I look at Target and say, yeah, it's a beaten up stock. It's a broken stock. They're probably not operating that well. But in the context of, catch-up trades, this might be one you might catch something here. So you don't need to opine necessarily, but this is one that I wanted to bring forth, Carter.
I mean, the thing to marvel at, of course, independent of whether it's a good trade here and now, is to think the spurious sort of gray area of valuation. What is something worth? They call it the cult of equity. I mean, it's $100 stock in the COVID low, then it's a $275 stock, then it's back to 100. And that's why, bond holders, they go, oh my God, public equities, that's dirty stuff. I mean, I'm a bondholder. I have a credit. I can demand your shareholder. It can be zero. Thanks for playing. It's zero. I mean, this is scary. Target, we've all been in one. You see what they do. They got the aisles like every other store. They got the cash register. They got the things on the shelves. And yet it's a $100 stock. It's a $275 stock. It's 100. I mean, that's a bad business.
Yeah, it's interesting you say that, because effectively, things change on the margins, but to the extent that the stock moves, I mean, the change is not nearly commensurate with the moves we've seen in the stock, to your point. So the market's having trouble trying to figure that out, and I understand what you're saying. The other one, this is just sort of, again, a trading call, valuation call, but, Home Depot, which, by the way, I don't think a lot of people realize. I mean, this is a stock that made its all-time high, I want to say, in December of 2021. If you go back and look, you'll see what I'm talking about. And again, a broader market that's done pretty well. I mean, a stock that really hasn't been able to get out of its own way for quite some time. With that said, I'm saying to myself, okay, sort of doing this little sideways action here. Maybe just as people potentially rotate out of technology. And again, that's a big hill to climb if that's going to in fact happen. Where are they going to find their way? Well, they may find their way into things where they can actually rationalize on valuation. And I think Home Depot might be one of those things. So I look at this and say, this might present itself as a bit of a catch-up trade as well.
Yeah, I mean, again, for me, more of a pair of twos, but I mean, Home Depot, if you just were to take the chart out of it and say, at any time when Home Depot trades below a market multiple, it does, in the history of Home Depot, you were well served to buy it.
That's exactly, yeah, and that's, and by the way, I mean, this is a stock that is traded at a premium valuation at times, and now is probably trading at or slightly below a market multiple. So I'm glad you brought that up.
22 times versus market at 25. And so one could say, but it's finally, they've rolled up all the hardware stores they can. There are no more towns to move into. It's a saturated thing. They've got to cope with lows. It's too cyclical. It's tied to the housing market. Listen, that's great. That's fundamentals. But one could also step back and just say, this is one of the great commercial enterprises in America. And hard stop, at any point when you had a chance to buy it lower than an S&P multiple, you were well served, which is true. Let's just go with that. Have a 5-year view. Okay, I'm with you.
You brought a couple as well, and we did an options trade on Pfizer a while ago, and we actually caught it pretty cold in terms of the setup into their earnings release. Not that necessarily it was an earnings story, but you might, in the absence of a disaster, you might catch a bit of a bounce, and that's what's happened. So your first catch-up trade comes in the form of Pfizer, and you brought some charts.
Yeah, so this is a report from last week, and let's just look at it now. This is Pfizer with no lines. First line, what we have is a downtrend line, and we have a move above the downtrend line. Second line, we have a formation. It doesn't matter what you call it, heads and shoulders, cups and handles, all that's kind of hooey. It's what a reversal is. It has a reason. Let's keep going. We have other iterations. Basically basing. Yes, it made a slight new low in sort of April of this year, but that's the rate of change of descent is ending, and so it has all the feel of a turn. Put them all together, or of course we just use the smoothing mechanism, the 150-day moving average. It is now officially flat. Anyway, a bearish to bullish reversal. And one final chart, I think we have a long term, not random here. You're talking about, again, okay, Lilly's the flavor of the day, or Merck, or Novo Nordisk, or whatever all this is. Listen, the biggest pharmaceutical always was Pfizer. And Pfizer is either going to go out of business, I'd say no, or they're going to get themselves straightened out somehow, fire all the managers, get new managers in, acquire someone, or invent their own new drug or something. But it's not random that you drop 60+%, go right to the COVID low, and start to dig in. I'm a buyer.
I agree, and I'll say this. I mean, it's not that Pfizer has figured it out or their woes have been fixed by any stretch of the imagination, but, you sort of get towards levels where you've discounted all potential bad news. And again, I mean, could there be more bad news? Absolutely. But, you look at these levels and you look at the fact that basing process, if you go back a couple charts and see that sort of bullish to bearish to bullish reversals that you talk about all the time. And this is textbook stuff. So, you sit here at 30, I don't know exactly what's trending, $28.50 or so. And you say to yourself, it's not out of the realm of possibility for this thing to be trading in the low 30s over the next couple of weeks. And without anything really changing other than exactly what you've pointed out, this sort of bearish to bullish reversal. Again, not to suggest that they fix themselves, but you can absolutely see that. Nobody's coming in and buying Pfizer. We get it. It's a $165 billion company. So that's off the table. But you can sort of see this levitation, especially, Carter, if people start to rotate out of some of the higher flyers, for example, the aforementioned Novo Nordisk and Eli Lilly.
Right. And again, despite obviously it's in a tough patch here growth-wise, it is obviously at this point a handsome yield. And the notion that somehow Pfizer is going to cut their dividend would be absolutely unlikely. Yeah.
Insight's the next one you brought forth. And again, it's a stock that if you look, I mean, since I want to say probably 2017 or so, this has been upper left, lower right, not particularly interesting, but every once in a while, something happens where you take notice. And I think what happened is, we traded down to sort of $51.50, $52, which was the low sort of in November. And a recent low that we just made, I want to say at the end of April. So let's walk me through that, because that chart speaks to exactly that.
Yeah. So let's put some lines on. Maybe we can flash that to call attention to it. What are those? Those are two heavy volume up thrusts, gaps. The first one. That's what's called bullish price volume correlation. And one could say, well, was there new? Don't care. Surely something was said. An FDA approval maybe, or maybe they had earnings, or maybe a journalist wrote about it at Morgan Stanley and Goldman Sachs and said they like it as a buy. It doesn't matter what it is. It's something that's the definition of accumulation. Let's keep going. There's a trend line. You say, that's not a trend line. That you just connected 2 points. Pull this chart back. It's an important trend line. We are on the cusp, having put in a double bottom, of moving above this downtrend line that's been in effect for the past 3 years. I don't know if we have any other longer term, but yeah, final iteration. I mean, do you buy that setup? This is the thing. This can drop to 20 tomorrow. Sorry, you lose. But here's the thing. If you're playing cards and this hand is presented to you 100 times, 1940, 1980, 2080, when we're all dead, do you play this hand long or short? History reveals you play it long. Does it mean it has to work this time? No, but that's the play.
No, and listen, I agree with you. I mean, obviously, you're talking about, again, in the same world, but this is a company, instead of being a $160 billion company, it's a $13.5 billion company-ish. So, again, I'm not saying there's going to be a buyout here. However, in the world of pharmaceuticals right now, That's always out there. You know, these tack on, these sort of bolt on names are out there in spades, and we've seen a bunch of different things. And you look at this chart again. I mentioned the fact that we made that low in November. We basically traded back down to it in middle to late April, and now we're bouncing. You want to say you fade this because that's been the right thing to do for the last 7.5 years? Yeah, okay, that's fine as well. Or you could be playing for that breakout, which may occur. So I'm with you. I think you brought forth two really interesting names here, Carter, without question.
Yeah, and healthcare, there's sort of a defensive nature to that as well. So interesting. We'll see.
Anything stick out to you today? Because I'm trying to get my arms around a few different things. Again, I don't want to make a huge deal out of not even a full day's worth of activity, but you have seen some reversals here in the broader market. Again, we've mentioned the Russell 1,000 times. The IWM is what I look at, but its inability to sort of get through 207 to me is really interesting. The bond market, you've been talking about that. Lower yields are seemingly bullish until they're not. Is there anything sticking out to you today before we sort of let you go?
Yeah, I mean, decliners are 3-2 over advancers. NVIDIA made a new high and is in the red here, a bit of a reversal intraday, not enough to make anything out of it in a big way, but it's noteworthy. And then again, energy sort of perking up a little bit, which I think is defensive ultimately. So here we are at a new 52-week high, an all-time high for the S&P 500, and yet we're not. Of course, for the S&P 400 mid cap and the S&P 600 small cap, the Russell 2000, the Dow Jones Industrials, and on and on and on. An interesting juncture for the market. No real catalyst, of course, now day to day. At some point, earnings come again, but here and now, we're kind of in the early days of summer. We shall see.
Got a jobs number. You got the Fed next week. I think CPI is the same day as the Fed. I think it's the 11th of June, which is what I want to say it's next Wednesday. Or Tuesday, or I don't even know at this point. I'd lose track of time. But you got those things coming up as well. So there are some market moving things out there. But, again, in the absence of bad news, this levitation that's been taking place has been remarkable. But I will say again, you're looking, at least I've been looking for, a similar day to the March 8th reversals that we saw. And today, right now, at least at 1:30 is about as close as we've come. So stay tuned for the rest of the day, Carter Braxton Worth.
All right.
You are the man. I appreciate you joining. I like the green flannel. We're going to end a little early today because I got to head uptown. Thanks for indulging us. Dan will be back on Monday. And thanks for joining, folks. Oh, before we get out of here, Carter, I apologize. We are doing something on the AI front. Throw that up, Amanda, real quick, because Market Matrix comes out every day after the close. It's our new AI-generated podcast. Dan explains it much better than I do, but it comes out each day after the close in anywhere from 6 to 10 minutes. You'll basically get caught up on what's happening during the day and potentially what's going to happen over the next few. And by the way, if you were to leave a review, slide it, Earl, in terms of our next slide, we're going to send you a pretty tricked out t-shirt. So as Amanda will say, leave a 5-star review and we will send you a t-shirt if you send us a screenshot of that review. And if you send us your address and size, we will send you a t-shirt, which is pretty, as the kids say, Carter, dope.
Dope. All right.
Thank you for joining, folks. We will see you on Monday. Enjoy the rest of your day.